we are very confident, unusually confident, in this growth acceleration story, because in the case of the United States, it's predicated largely on reduced fiscal drag. In other words, less taxing and spending by the government. The cutbacks in government spending this year are going to be significantly smaller than the cutbacks in government spending last year. The increases in taxes that we saw last year will not be repeated this year. So the amount of fiscal drag, or the extent to which actions by the government slow economic growth, is going to be much less this year than in 2013. And this should allow US economic growth to accelerate by a percentage point, from something around 1.75% to 2.75%. The story on China is that most of the slowdown in economic growth is behind us. Growth has already slowed into the mid-sevens, and we expect it to hover around that range, maybe a little bit lower in 2014, but certainly all the significant slowing is now behind us with China.
We continue to be overweight to the developed market equities, given the potential for further risk appetite in the market. We see the environment being favorable for an overweight to risky assets versus lower risk assets such as debt. So we maintain an overweight in developed market equities, and within that space, we see Europe as the most likely for generating performance from the equity markets this year, because of the potential for earnings expansion in Europe. And we still remain favorable to the Japanese market, followed third by the US market. So although in growth terms, we certainly are very positive on the US, we actually favor, in terms of potential equity market growth this year, Europe, followed by Japan and the US. We remain underweight to our strategic allocations on emerging markets, given some of the concerns that Chris raised. We also remain underweight to the sovereign treasury markets, given that we see them as more overvalued safe haven assets within an asset allocation, and ones that will see a gentle increase of yields over 2014. Not a radical increase in yields in the US Treasury market, but a gentle increase in yields.